welcome everyone. So every year, TBR puts out a predictions document for the following year. And today we're going to be talking about the telecom industry outlook. So this is me, Principal Analyst Telecom Practice. My email is there. If anybody wants to email me, feel free to do so. Before we jump into the content, for those of you who aren't already aware, the Telecom Practice has a research portfolio of subscription service. And these are the list of the reports that are part of that subscription. And we have a variety of benchmarks, market forecasts, and market landscapes that look at key areas of the telecom ecosystem, such as 5G, 6G, the hyperscaler involvement in the industry, edge computing, private networks. We also are launching a new report for this year around telecom AI. We're looking at AI and Gen AI, not just Gen AI. And I want to make that clear. We're looking at the totality of AI as it is coming into the telecom ecosystem in that report. And I will be doing a webinar on that report in the April-May timeframe. So if you're interested in that, keep an eye out for an invitation. Some of my other colleagues at TBR are also doing AI-related webinars, podcasts, videos, and other materials that will be available for general audience viewing. Those will be made available over the next few months and really throughout the year. We have a pretty significant slate of AI-related research coming out as it pertains not only to telecom, but also all of the other major sectors within the ICT ecosystem. We also have reports on vendors and operators. Those are individual reports. We obviously cover many more operators and vendors than are listed there, but those are some of the companies where we have dedicated, off the shelf, if you will, reporting on. So with that, we'll go into today's agenda. We're going to be talking about how companies in the telecom industry are responding to the macroeconomic situation. We're also going to talk about industry-specific challenges. So we have the macro stuff that's going on, macro and geopolitical. I'll add that in there. And we also have industry-specific challenges that are coming up, and also opportunities. We're also going to be discussing how and why CSPs are prioritizing cash flow management. We're going to be talking a lot about cash flow on this call, and you'll see why as we get through the material. And lastly, we will talk about Open RAN. The Open RAN market has not been going well. There's been a lot of challenges with that, and we do not believe it's going to be ready for mainstream adoption this year. And we're going to talk about why that is. All right, so let's jump right in. We're going to start with setting the stage. We'll talk about the macroeconomic picture. So there was a variety of challenges and trends that started in late 2022 and through 2023 that are going to persist through this year. One of them is inflation. Now, inflation rates, generally speaking, have come down from where they were. However, if you look at the long run inflation rate, historical inflation rate, and expectations of consumers and businesses for price increases over the future timeframe, there is a structurally higher level of inflation now embedded in market psychology. And that means that maybe in the US market, instead of 2% historical inflation over the last 2 decades, going forward, we may have 3 or 4% inflation. Now, that might not sound like a big difference, but that actually is a significant change. And that impacts cost of capital. Think about interest rates that you would get on debt. It impacts discounted cash flow models that Wall Street uses to ascertain equity valuation. It impacts the prices and the price expectations that end customers are expecting Maybe they have a higher propensity to switch. So maybe we'll see a churn impact. So it might not sound like much, but I want to make sure that I drive home the point that it is structurally higher going forward than what it has been over the last 1 or 2 decades. The second thing we see, and this relates to inflation, is sustained higher interest rates. Now, the Feds, the Federal Reserve, and other central banks in other major markets around the world have been doing synchronized interest rate increases over the last 2 years. They've kind of flattened out the increases, but we're at a higher level than we were over the last 2 decades. Now, that impacts cost of capital. So when the telcos and the vendors come to market to refinance or roll over their debt instruments, they're having to pay 2, 3, or more times the interest level that they originally got that debt with. That is very significant and impactful to cash flows. It's impactful to CapEx decision-making. It's impactful to how the company will behave to adjust to that new reality. Lack of 5G ROI. So there is one use case that we've seen, and we've been looking real hard for this. One use case that's actually driving revenue growth at scale with a positive ROI for the telecom industry globally, and that is FWA. Aside from FWA, yes, there's pockets of revenue growth, but the ROI may not be there, or the scale may not be there. And as we know, telco is a scale business. You need to scale profitably to move the needle on your P&L and to drive earnings growth. The industry is still looking for other sustainable, high growth, scalable use cases for 5G. And this is something we'll be looking for at MWC. But we don't see any material catalyst on the horizon for this year. We don't see anything aside from FWA. I want to make that very clear. Now, after this year, we may start to see new use cases for 5G really ramp up. And I'm sure we'll be covering that in the 2025 predictions. Technological complexity. RAN is problematic. Open RAN is not working out. It's not delivering the outcomes, and it's not meeting the expectations, generally speaking, of the telcos. It's falling short. And vRAN is doing better than ORAN. vRAN is more developed than ORAN. However, doing just vRAN, you don't get the full benefit that the telcos are expecting to get from this new radio architecture. So they're only part of the way there. This is a problem. We do not see this problem being fixed this year. Maybe next year we'll start to see breakthroughs and catalyst moments for Open RAN, but for this year, we're not expecting one of those catalysts to happen. We are seeing the end of pandemic era government stimulus. Now, if you were on prior webinars of mine, we talked about government stimulus during the pandemic era. During the pandemic years, governments of the world created, through monetary and fiscal policy measures, over $35 trillion in stimulus. A portion of that went into the technology sector. Around 10% of that, we estimate, went into the technology sector, of which telco is in there. Even 10% of $35 trillion is a lot of money. And that money went into a whole host of programs. Build America Back Better, the America Recovery Plan, the Tribal Lands Funding, BEAD, the ACP. There were also debt moratoriums. So this is indirect benefit to the telecom industry. People's debts were either paid off, such as student loans. Some of that has been paid off. There were also enhanced unemployment benefits people were getting, many hundreds of dollars more per month if they were on unemployment for well over a year. In some cases, we're aware of people getting those benefits for up to 2 years. That is many thousands of dollars per household. That was a capital infusion. This was not just in the US, this was also in Europe. This was also in some markets in Asia. And when those things happened, people had more money to spend. And what we saw was an upswell of device trade-ins. We saw people buying new devices, computers, phones, et cetera, for home office use, as well as just because they could afford it all of a sudden. And these are things that directly and indirectly supported the ecosystem in various ways. Those programs are rolling off. Some of them have already ended completely. Some of them are in process of winding down. There's a couple of instances where things have not really ramped up yet, like BEAD. BEAD funding is going to happen over the next few years. It started last year, but it hasn't really ramped up yet. So those are some of the things to keep in mind. Also, some of the swap structures in place have not really ramped up yet. But generally speaking, if we look at magnitude, the vast majority of that upswell of government-supported stimulus is over. So the CSPs and the vendors have begun adjusting to these headwinds in their industry and in the wider economy. Now that's what we're going to talk about going forward here. If anybody has questions, feel free to add them to the chat box and the Q&A box, and I'll take them one by one at the end. So what's the industry's response to this? Behavior is changing. I want to give you tangible examples of this happening. We are seeing telcos and vendors reassessing their capital structures and their capital allocation. And this is leading to a variety of outcomes. We have seen dividend cuts, completely doing away with the dividend. We've seen CapEx reduction, not just because they've done nationwide 5G deployments, but also because of macroeconomic and other considerations. We have also seen, and we expect to see, a significant increase in M&A. We are seeing write-downs and asset revaluations. In the US market, there was a tier one telco, I'm not going to name the name, but they wound up writing down over $5 billion of, they took an impairment for their enterprise business. Now, that is just one example. We have seen many asset write-downs at various telcos around the world over the last 12 months. We are expecting to see further asset write-downs. These are one-time hits to the balance sheet. They're usually non-cash in nature, but they are telling of what is the real value of the assets the telcos are carrying, what is the value of their brand, and those are things that are very interesting to consider in the context of outlook. We have seen several operators scale back their fiber build targets. I'm not going to name names, but there were 2 or 3 telcos in the US market. I think there were 3 that have officially stated that they're doing this. That they are, so maybe they were planning to do X million homes passed with FTTP. What we have seen in the last 12 months or so is that they have reduced the scope of what they're going to do for a build. There's various reasons why they're doing that, but one of the biggest reasons why they're doing this is because the cost of capital is fundamentally higher than when they originally put those build targets out. And what that means is that it is no longer ROI positive for them to do the full scope of what they originally wanted to do. That is a significant development, okay? These are examples of behavioral changes among the telcos and among the vendors. CapEx budgets are being reduced in many cases. We have seen very few telcos globally, when we look at the global landscape, very few instances where telcos are guiding to higher CapEx this year. Very few examples. The vast majority of telcos that are putting out guidance are indicating either flat CapEx or lower CapEx for this year. So this comes back to the CFO. And one of the things that we will be watching very closely this year especially is more examples of behavioral changes. And these things are going to come from the CFO department. And when you see these things, you will know that these are adjustments to the new reality, the post-pandemic economy, the non-stimulated, artificially supported economy. So everybody's adjusting now to what is that new level going to look like. Okay. So this brings us to the first prediction. And I mentioned it before, but M&A. The M&A market was relatively subdued the last 2 years, relatively subdued for the telecom industry. We are expecting this year that we are going to see a significant increase in M&A. Some of it will be forced and some of it will be pre-planned. Now, when I say forced, what I mean by that is we will see situations where operators and vendors get into a financial, they have a financial reckoning, let's put it that way, where they need either a massive capital infusion to continue their business, they need to do a structural sell-off of assets to pay off debt, they need to make structural changes because the business structure that they have is not aligned with the post-pandemic economy. I'm going to give you guys examples of these things. I'm not going to just say I'm not going to say these big statements without giving examples. I'm going to give examples for everything that we're showing here. And then pre-planned M&A would be situations where you have a telco or a vendor that is in a relatively strong financial situation to take advantage of market opportunities that arise from other entities that are struggling, or where the valuations are coming back down. Maybe there's a software company or a cyber company or a services company or another telco whose valuation was very high. Maybe it gets revalued, and maybe all of a sudden the ROI and the deal all of a sudden makes sense. We're going to see situations of this. We also expect that these things are going to be approved by governments. So historically, there's been resistance to doing fewer than 3 tier 1s in a market. We are starting to see 2 tier 1s in a market, and that's starting to become where things may be going. Not in all markets, but in select markets, we may start to see even further reduction of tier 1s in a particular market. I'm going to give you guys examples of these things, so just hold tight. So the trend is that M&A is going to heat up this year. We are expecting to see a lot of stock deals where, because the cost of capital has increased, we may see more equity components to M&A than cash components. That's something we're going to be watching. That's what we're expecting. The driver of this trend is macroeconomic and industry-specific challenges, which we've already discussed what those are, some of them. And the result, we're going to see fewer but larger and stronger entities remaining on the vendor side and on the operator side. And when I say operator, I'm including telcos, fixed and wireless. I'm talking about the satellite connectivity providers, and I'm talking about the cable cos. That's when I say CSP, I'm including all of those entities in that bucket. Okay, so examples. So there have been bold M&A combinations that have already happened in the recent past. And these are things that maybe 5 or more years ago, the governments would not have allowed to happen. But now they have happened. And the Roger Shaw deal is one of those situations. Again, 5 or more years ago, before the pandemic, if Rogers approached Shaw and said, we want to buy you guys, and the government's going to going to get this is going to be approved, it wouldn't have happened. There would have been a flat out no matter what. No concessions are going to make this happen. Okay, that was the environment at that point for that type of an acquisition, right? Where the number 4 player is being taken out by the number 1 player. That deal has since closed. There were concessions made, of course, which is to be expected. Videotron did take a portion of Shaw to balance out the competitive landscape post-acquisition. But the point I want to stress is that deal was ultimately approved. The DTAC True deal in Thailand also closed. That would not have happened pre-pandemic. These are situations where the deals, all of a sudden, they're being green-lighted, with concessions, of course, but they're being green-lighted. One that's in play right now, which we expect will happen, is Vodafone UK and Three UK. We do believe this deal will happen in some way. There will likely be concessions, but the deal will get approved. That is what we believe is going to happen with that deal. We are expecting at least a few more big M&A events to happen this year in the telecom industry in various parts of the world. The stage is set for this to happen. The trends are in place to move the industry in this direction. And the government regulatory environment and the competitive landscape is such that we think more deals are going to actually get green-lighted. Okay, so the next prediction is cash flow management. So cost of capital is increasing, and this is driven by central banks engaging in what we call quantitative tightening. Now, post-Great Financial Crisis in 2008, 2009, what the central bankers of the world did is they reduced interest rates to artificially suppressed rates, dropping them to levels never seen in the history of mankind, okay? To zero, in many cases, zero interest rate, and there was even negative interest rates in Europe, in many countries in Europe. They had negative interest rates. That is historically unprecedented. Nothing like that has ever been seen before. That is what QE looked like. The reason the governments did that was to bail out the financial system and support the economy through that tumultuous time. It did wind up working, thankfully. However, it created a moral hazard situation, and it created a situation where governments became accustomed with sticking with QE because it was driving their economies at a higher rate of growth than what they were getting beforehand. When you reduce the cost of capital, you encourage investment, you encourage spending, and that's exactly what we've seen. We've seen those things happen, not only in the telecom industry, but in the entire world. So we are expecting, now that things are moving away from QE, there's still elements of QE in place, but now that there is a pivot away from QE towards QT, we are expecting to see telecom entities becoming more conservative with spending. And I want to give examples of this. So the list of names here are companies that have explicitly said on earnings calls, at investor presentations, in interviews, on business media, that they are focused on cash flow. And this is a trend. We are seeing, since we made this chart in November, we've seen several more companies to be added to this list. So this is definitely a trend. But the amount of times that the word cash flow or cash is being talked about on earnings transcripts in the telecom industry has significantly increased over the last 2 quarters, I would say. We've ran an analysis. We have an AI thing that we ran the transcripts through in the industry to look at number of times of mention. And we do see an upward correlation there in companies are talking about this much more. Okay. The third prediction is about Open RAN. Now, Open RAN was, everybody was talking about this, 2 years or so ago. This was going to revolutionize radio. I ultimately believe it will. This will happen. The question is, when is it going to happen? What has wound up happening is the complexity and the vested interests, the power of vested interests in the ecosystem have been insurmountable challenges thus far. And what I mean by that is companies that may not want to open their interfaces because there's a competitive aspect to that. They may have value at risk by taking that strategy. So they didn't participate. There is embedded install base in the ecosystem, in networks globally, where introducing Open RAN into brownfield environments is extremely expensive. And there's challenges with feature parity, backward compatibility, seamlessness of service. These are challenges that have proven to be extremely expensive, and it has significantly slowed the momentum of Open RAN. Virtual RAN is doing relatively better. However, we do still need silicon innovation because hardware acceleration is required still for vRAN, and that is very power hungry, and it doesn't run efficiently. There are companies working on silicon to run radio workloads much, much more efficiently at the edge of the network. Once those types of chips start coming into the market and getting into commercial equipment, we're going to start to see real benefits coming from virtual RAN. There are other benefits of virtual RAN that are being realized today, such as composability of software, software chaining, things like that, service chaining. So there's good momentum already for vRAN. But from an Open RAN standpoint, it's going to take some more time for that to build momentum again. And it's not going to be this year. So again, the complexity is slowing this market down quite significantly. Classic RAN is going to stick around for quite some time. At least through this decade, Classic RAN is going to be the de facto architecture. And the result is, as we said, Open RAN is we don't see a catalyst moment for Open RAN this year, if I put it another way. That's how I would describe it. So what we have here is a chart with some data that we've generated. This looks at the three radio architectures. So you have the classic or traditional RAN, you have vRAN, and you have Open RAN. Now, ultimately, the end state radio architecture is supposed to shift to open virtual RAN, both. It needs to be open and virtual. That is the end state of radio architecture. But what we're seeing is operators are starting, in most cases, they're starting with one or the other. In most cases, that's what we're seeing. So as you can see here, we project out 5 years out to 2027. The vast majority of the radio market in later this decade is still going to be classic RAN. With vRAN and ORAN growing in the mix over time, with virtual RAN growing at a faster rate compared to Open RAN. Okay, so that's the three predictions. And with that, we'll open it up for Q&A. I see there is some questions in the queue, so I'm going to start and work my way up. So the first question is about interest rates. This person said there's a lot of talk about interest rates peaking and starting to come down later this year. If this happens, how does it change your predictions, if at all? So actually, this is good timing because the U.S. Federal Reserve Chairman Powell just yesterday did a press conference about this topic. From a U.S. standpoint. And he said that they are not planning to reduce interest rates for the March meeting, and that the number of cuts that the market is expecting, which is 5 to 6 this year, that's what Wall Street is, that's what the general consensus is in Wall Street, is for 5 to 6 interest rate reductions this year, which, by the way, is historically like unprecedented amount of reductions. So he's indicating to maybe 2 or 3 reductions. Okay, so he's setting expectations and calibrating market expectations with the economy. And so I would say, yes, it's true that rates are probably peaking. There is some geopolitical issues in the Middle East, in Asia, that could create a supply chain problem, could create an energy crisis that could restart interest rate, higher inflation, which would cause the central bankers to either keep the rates where they are or maybe even increase them again. But barring something like that happening, let's say the rates come down 2 or 3 cuts this year, 25 basis point cuts. So in the States, you'd go from 5 to 5.25% down to, say, 4.5%. The telcos are still paying at least 2 times the interest rate at those levels than they were just 18 to 24 months ago. So on a relative basis, yeah, it's a little bit better, but it's still significantly higher than what the industry was accustomed to for a long period of time. So I would like to. So I think my short answer to that is yes, that's probably true how you're framing it, but you have to look at it in terms of relative changes over a time period and how much things have changed in an absolute way from one time period to another time period. Okay, so the next question is, does the success of 5G and FWA reduce the impact of the reductions of fiber buildouts? I think it does. That's definitely a driver. But I think, so when we did an assessment of the several companies that have announced a scale back in the fiber builds, there's several reasons driving that. We believe that one of the biggest reasons is cost of capital, because your marginal homes passed or businesses passed, all of a sudden, because the interest rates are higher, all of a sudden the ROI doesn't make sense. So they would say, okay, well, we're not going to do these markets now or these neighborhoods or whatnot, because the numbers don't work anymore. When they run the numbers, they don't look as good as when they ran them originally for the target. So yes, FWA I think does impact that. That also impacts pricing in markets, and that would also impact ROI calculations. So I think when you take all of those things together, it's driving those overarching decisions. So the next question is, which markets do you see M&A picking up? Okay, so India, something needs to happen with Vodafone Idea. This is well known, and it has been well talked about in the industry that they have a financial crisis at that company. And there needs to be a solution this year. They can't wait any longer. Something big has to happen with that company this year that will either put them on a path to recovery or will redistribute those assets to other entities. So that would be one example. We would expect M&A in Europe. We expect M&A in the States. We expect quite a bit of M&A in the States, actually. There are several companies, I'm not going to name names, but there's several companies that their finances have deteriorated to the point where there will need to be a significant change in their financial picture this year. They are not going to be able to push the can out to next year. It's going to have to be this year. And that could be Chapter 11, debt restructuring. It could be Chapter 7, where there's a redistribution of assets to other entities. It could be a partial or full government nationalization. It could be an asset sale. So it could be a line of business. It could be certain assets. Maybe there's real estate that a company's carrying that they want to sell off. there maybe there's spectrum that a company has that they have determined to sell off. All of those types of situations would be in play, especially in the U.S. market. Okay. Next question is, yeah, so someone mentioned some other, another example of M&A, I'll just mention it's Orange, Spain, and MassMobile. So yes, thank you for mentioning that. That is another example underscoring that the M&A environment is heating up. And again, these combinations now, where the number one or number two player is buying the number four player, those are happening now. Before, those things would not have been considered by regulators. So that's a change. All right, the next question is, who are the vendors in the cash flow predictions? I missed the slide. All right, I'm going to go back that slide. I think it was this one. Yeah, so this is the list. Again, this list, since we wrote this report in November of last year, since then, we would be adding more names to this list that have come out and explicitly said that they are prioritizing cash flow management. Cash flow management is the phrase that we're using to wrap these into, but they will use different phrasing and words to describe this, but they're basically describing the same thing. So we're just wrapping it under the notion of cash flow management. The next question is, when do you see ROI coming in for 5G investments? There's so much discussion on monetization, and I still see operators struggling. So yes, when? So ultimately, I do believe that 5G will bring, 5G in conjunction with AI and edge computing and those new technologies, because a lot of them interwork with each other to bring outcomes. Trillions of dollars in new economic value will come from these technologies, including 5G. It is going to happen. I'd say we're at the very, very early stages of this still. Even though we're 5 years into the 5G cycle, we're still at the very early phases or early innings, if you will, of the actual monetization of new business models from that technology. I think that we're going to see, as this decade moves forward, I would expect in the later years of this decade, we're going to see telcos generating significant new revenue from 5G. So there's still a ways to go. Again, I'm excluding FWA from that. Like other things beyond FWA, we're still a couple years away from scaled positive ROI, use cases that are driving a positive ROI for the telcos. Okay, the next question is, any specific observations for 5G Open RAN rollouts in Europe? So Open RAN is still happening regardless or despite the challenges, but the scope of what's happening is much smaller than people were originally expecting. The industry was originally expecting that there would be large-scale macro network deployments of Open RAN. What has wound up happening, maybe with the exception of Dish in the US, and maybe Rakuten in Japan. So maybe a couple telcos would be exceptions to this rule. But any telco with brownfield networks, what they have wound up doing with Open RAN is very small scale trials, pilots, or they're using them for a very specific use case, like small cells in building, as an example. Introducing Open RAN into brownfield macro networks is not happening. It's not happening on a commercial level. Maybe on a pilot or trial level, it is, but from a scaled perspective, it's not happening yet. And we do not expect that this year that's going to happen for brownfield. For greenfield, it is happening. For brownfield, we're not expecting a big catalyst this year. The next question is, are competition regulatory authorities prepared for the likely uptick in M&A, bearing in mind the BTEE deal in the UK? So If you look at the trends, and we gave examples, I'll actually go back to that slide. So if you look at these deals, 2 of which have closed, and one of which that other person mentioned on another question, these are all examples where tier ones are buying up tier 2, or maybe even, depending on how you consider tiering, operator tiering, they're either buying another tier 1 or a tier 2 company. These tie-ups are being greenlighted with concessions, but they are being greenlighted in the, for all intents and purposes, they are being greenlighted with some concessions. So that is a change. And I do think we're going to see bolder M&A. We're going to see more tier ones come into the market with deals, setting up deals for horizontal M&A, and we may even see some vertical M&A, but we're expecting the majority of the M&A to be horizontal in nature. Remember, telco is a scale game on the vendor side and the operator side. They're going to be looking for situations where they can enhance the economies of scale so that they can offset maybe revenue erosion or flattened revenue, and they can increase their earnings per share by getting that scale. So those are some of the things to keep in mind there. All right, the next question is, how do you see sustainability playing in the telecom industry? What are the key initiatives operators are embarking on for sustainability? So from a sustainability standpoint, the majority of what we see from a telco perspective is energy management. So anywhere where they can get energy efficiencies, that's where they're making investments. And I'll give you some examples of this. I'm not going to name names, but there is a tier 1 vendor that has an energy SaaS solution that they sell to operators. They have a few customers in Europe. I'm not sure if I'm allowed to disclose them, so that's why I'm not mentioning names here. But they are running their radios on this platform, and they have realized, I think, somewhere between 5 and 15% reduction in energy usage of that radio environment at scale. So if you think about energy costs from a telco perspective, that's one of the biggest OpEx items that they have. And 5G is also energy intensive, right? It does consume quite a bit of power. So if you're able to get 5 or 15%, somewhere in that range, energy efficiency by using advanced algorithms that tell the radios when to turn on and turn off, depending on traffic flows autonomously, that is a very lucrative opportunity for telcos from the perspective of cost savings as well as meeting sustainability objectives. So that it's a win-win all around when those types of situations happen. And we see, even outside of Europe, we do see operators looking at energy efficiency solutions to address that and meet sustainability objectives.